Hi, Steve Van Metre here, and welcome to your Monday Night Premiere, where we take about 15 minutes every Monday and Wednesday night, try to make sense of markets that really don't make any sense. And how can they make sense when the coronavirus appears to be spreading and U.S. investors bid up equity futures and buy stocks in early trading? It's baffling. And yet, so many investors say, well, next time I will see when the bad times come, I'll know and I'll get out. But yet you've got crude oil closing at 49 a barrel, between 49 and 50. You've got the 737 MAX production line shut down, which is going to have knock-on effects across the entire industry. You've got a virus spreading. You've got the world's largest exporting nation shutting things down. And people want to buy stocks. They couldn't see it if they wanted to, and that's the problem. We invest based on what we see behind us, not what we see in front of us. And when markets move up on bad news, it just tells people, don't worry. But when the worry hits, well, it's going to be ugly. And when might that happen? Well, there was a great article on Zero Hedge today that says when 3254 is the only number that matters for traders today. Now, they don't publish articles like this overly frequent. So if you're hoping to go here after you see what I've got and to share with you and you want to go read it every day, well, they absolutely do not publish this data every day. It's occasionally because it's only for certain investors. And occasionally they do get permission to share it with the general public. But according to Nomura's cross asset strategist and quant Charlie McElliott, there is a problem in the markets at 3254 where dealers will do a gamma flip. And what is a gamma flip? Well, it's simply dealers hedge against positions. So when people are buying stocks, they have to hedge the downside. And when stocks fall, they flip their switch the other direction. And 3254, if the market was to close below that, and it did, it means the dealers are going to have to shift their hedging. And currently, their design to hedge market makers is currently suppressing or elevating, or it determines if they're suppressing or elevating volatility. And dealers have been suppressing volatility, and that is going to change starting tomorrow. But that's not the only issue. And again, you can go through and read this article on your own. It's at zerohedge.com, and you saw the title there. It's beyond that is the CTA quant models. And what you see here is they're watching 3250, and they share this nice chart of where all the quant models and how they're positioned in their various asset classes, which is kind of nice. And they're talking about on the S&P 500, it's currently 100% long, and it is looking at the 2-week window is looking to flip short, or has flipped short, and that this thing could start to sell off even more as the market goes down. So right now, as of today, the number that mattered was 3254. That closed below, meaning the dealers are going to have to start their gamma flip, which should bring stock prices down. And as that brings stock prices down, it's going to bring momentum down. And these quant computer models, guess what they do? When momentum falls, they sell. And you can see up here, S&P 500, 100% across the board, and that is likely to go down. So that means they will sell as dealers are flipping their gamma switch and selling as well. And you can kind of neat, you can go look at West Texas Intermediate. You can see not across the board, but it's a short position and based on today and 1-day signals, and let's see, minus 70% on the weekly symbol. But you can kind of see that, different positions such as ag commodities, they're very, very short. So you can see these quant models are just shorting everything, which is good because when they're really short something like corn, at some point corn is going to go up or soybeans are going to go up, and it's going to force them out of their short position. So right now we know oil is headed down, and they're helping head it down, and they're about to flip and head and push stocks down. So this is very interesting stuff. But let's go on to how hedge fund managers are positioned. And what we see today, as of last Tuesday, thanks to Hedgeopia. And if you want to see this on the weekends, he does post them Saturday morning, so you can take a look at it. But this is interesting. Interest rates are falling and about ready to break down to new all-time lows. So we're really close to the all-time lows. And yet 10-year Treasury positions, speculators are still very short. They're not record short. They're not insanely short, but they're very short. And when you stack this on the fact that most investors don't even own any treasuries, it's even better if you do own some. And take a look at 30-year. No real change in position over last week, and yet yields are falling. And all that tells us is once yields break through, these speculators will go long to hedge their positions, and that will drive yields down even further. And so if you're kind of wondering why are they still short, well, because they still think interest rates are going to go up, and they're trying to defend those positions. And that's why we look at on the charts, you can see support and resistance levels, because right now that we're almost at the last line in sand of support for them. And if yields break through, they're headed much lower, and all these positions, you're going to watch them unwind them like crazy because they're going to lose a lot of money and need to protect their hedges. Let's take a look at West Texas Intermediate, very, very long, and yet oil is falling and demand is falling even worse. And it's unknown how long things in China will be the way they are or if they will get worse, but already oil demand there is falling. And yet U.S. speculators are very, very long oil, which suggests that oil prices could go much lower than most people think, not just from a demand perspective, from an unwinding of a speculative position. For those who like the oil industry, there will probably be a buy point at some point when these positions get unwound. That day is not today, but there's a lot more to come. There's still a little long the S&P 500, but not a whole lot. Looking at gold, I think we're at record long position in gold, and yet gold is not breaking out to new all-time highs. We're not seeing the mining stocks breaking out to new all-time highs or anything like that. We're just not seeing it. Well, I shouldn't say all-time high, but we're not seeing it really break out, which suggests that at some point gold will reverse and all of this gain will go with it. And that will be the point where if you're not in that space yet, it's probably when you're going to want to look at it, because at that point, all the speculative positions will be flushed out and the smart money will have a huge position in gold. They're long the NASDAQ, no surprise there because tech stocks have been leading the market, and they're very long small caps, which have been falling. Remember, small caps generally lead the market, so it's kind of interesting that they're increasing their long positions on the Russell 2000 as stock prices there are falling. And the dollar has been kind of range bound in this channel. I expect the dollar to go a lot higher. I mean, we are in a dollar shortage, but I do expect it to get up in probably the top end of this channel around $100. And that will be very, very bad for stocks when you are in a period of illiquidity and a dollar shortage and you get a rally in the dollar. Stock prices tend to tank. And take a look at volatility. They backed off some of their shorts, but they're still very, very short volatility. Again, suggesting that anything at this point can be that first domino that tips the market all the way over. And the last thing I want to look at is 10-year Treasury yields. Keep in mind the lower end of the federal funds rate is 1.5%. The 10-year Treasury yield closed at 1.524%, suggesting, based on the market, is telling the Fed interest rates are too high. The federal funds rate needs to go lower. As I've said, it needs to go lower. The Fed is inadvertently tightening financial conditions in an attempt to ease them. It's kind of backwards, but it is kind of how it works. And the market is telling the Fed you need to cut. And guess what? When the Fed does get around to cutting, and they will, you're going to watch Treasury yields go straight down. I mean, all the Fed is doing is putting more ammunition under this rocket that's going to drive Treasury yields. I guess a rocket's the wrong answer because we don't point it in the ground, but it's just going to drive Treasury yields down and bond prices straight up. It's going to be really interesting. We haven't seen this happen since back in 2007, 2008, and there was a huge return for anyone that owned bonds, and then they have the opportunity to flip out of those bonds and buy stocks. And when you look at that position in crude oil, you think, man, there could be a huge opportunity. And you're right, because when you look at oil and gas producing stocks, it's just telling you some very interesting things. First, let's take a look at XLE, the largest energy ETF, and it broke through support. Remember, I said support was right around this $55 per share, and its first layer of support is right where it is today. which is, we'll look at ExxonMobil stock, which is really mostly what we're looking at here, because ExxonMobil is a little over 20% of XLE, 19% goes to Chevron, and then the rest is spread around some other companies. This is suggesting there is a much lower share price coming, potentially all the way down into the $40 or an even lower, depending on where demand goes. You got to think what's going on in China. If it persists, you're losing a lot of demand. Let's look at Chevron under the same time scale. You can see that triangle pattern. It broke through. It's continued to see selling, and its next major level of support for Chevron is around 103, and there's a bit of support around 100, and from there you're almost looking at a revisit of its 2016, 2015 lows down in the 80s. Could come quick. ExxonMobil leading the charge lower. This is really interesting because ExxonMobil is closed right at support from 2010. And what's interesting about this is ExxonMobil got a downgrade by analysts today. And I want you to think about what that means. Because did analysts downgrade ExxonMobil stock when it was high? Here, anywhere in here? No. They waited until it breaks support, and then they announce a downgrade. Now, why would they do that? Because who do you think analysts work for? So what does it mean when they're downgrading now? It means they've sold off their inventory. They've got rid of all those shares. All the dealers that had ExxonMobil shares that wanted to get rid of them, they got rid of them. And now they're leaving the general public and other money managers holding the bag. That's what this means. They know prices are going down. They want prices to go down. And you'll watch, they won't announce an upgrade for ExxonMobil till long after it's bottomed and returned up higher. And then they'll say, hey, we'd like to offer an upgrade. And then that will, of course, get people to buy after, of course, all the dealers and smart money have taken positions at the bottom. So keep that in mind. ExxonMobil, from a technical perspective, if it gets below, say, $58 a share, there's really nothing to hold ExxonMobil in place until it gets down into the low 40s. Potentially major buy opportunities in the oil and gas sector coming, not tomorrow, but soon. And not only that, but these things pay big dividends. Of course, that also implies there's going to be a lot of debt defaults, but the majors are not going to probably have that issue. And isn't it interesting that it was a month or so ago, Oxy took out that big hedge on the downside of oil prices, and I said people were kind of making fun of them. And they don't look so stupid now, do they? No. There's a reason these producers are the smart money. They know. But yet investors always want to go against it every time. Here's small oil and gas producers making a new all-time low. This could be the sleeper story in the future because this thing, it could get very close to zero, and ETFs can't go to zero because they'll just strip out the bad companies and could offer a tremendous amount of upside potential. It doesn't pay a huge dividend compared to the big boys, but could be a very interesting growth story because at $49 a barrel, it's going to be a lot of bankruptcies in the oil patch, a bunch of them. Let's take a look at Treasury bonds, and then we'll kind of wrap things up here. Here's symbol TLT. Remember, we had this big bottoming pattern. The quant computer models traded this thing up and pushed prices higher. Then the quant models decided to sell, and we entered this triangle pattern. And it's a right triangle, and it usually ends up going down. But I said when it goes up, and of course the macro data, the monetary data, the credit data was all saying that interest rates have to go down, bond prices go up. And look what happened. It started to squeeze people out, squeeze. But we're not seeing a huge amount of volume yet. And you'll notice, why are we running into a roadblock here? This is going to be almost the last point of overhead resistance. Now, there's going to be some resistance in here, but probably not a whole lot. So sellers and speculators need to defend this position. And what's notable is the Fed did not make any direct asset purchase today. Now, I don't know if they're on cue to do it tomorrow. They don't. I usually don't find out until the day they're doing it. But at some point in the remainder of this month, they will buy $60 billion worth of Treasury securities. Some bills, probably if they can get mostly bills, but maybe some notes. And that is going to help put upward pressure on here, push this through resistance. And then once you have that, you are in the next bull market of bonds. And they never disappoint because you've got all those short sellers that have got to get out. And then you just get these just crazy straight up moves like this, where you get breakout and you can make a lot of money really quick. But you need to also remember that when you do that, you've got to also sell. I'm Steve Van Metre. Thanks for watching. We'll be back Wednesday. I'll see you then. The content of this video is provided as educational information only. It is not intended to provide investment or other advice. Material is not to be construed as a recommendation or solicitation by or selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Opinions expressed in the video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.